Is inflation about to bite markets again? This week's data could reset rate cut timelines and move stocks, bonds, and crypto. Here's the setup. Central banks still want inflation near 2%, but recent progress has been uneven. Companies are feeling higher input costs in energy, freight, and wages. When margins get squeezed, those pressures can spill into consumer prices with a lag. That is why investors are watching upstream indicators as closely as the headline CPI. The first insight is that pipeline costs are reasserting influence. Producer prices, import costs, and surveyed input indices have stopped falling, and in some cases are turning up. If that stabilization sticks, retail prices can firm months later, especially where inventories are lean and firms have less cushion. The second insight is services stickiness. Goods inflation cooled earlier, but services dominate consumer baskets in advanced economies. Tight labor markets and rising wages anchor those categories. When hiring remains firm, companies often protect margins by lifting prices rather than chasing volume, keeping core inflation elevated. The third insight is policy recalibration. After leaning toward eventual easing, central bankers now emphasize data dependency. If inflation progress stalls, the path of rate cuts can be slower and shallower. Moves typically come in 25 basis point steps, and each step flows through to mortgages, auto loans, and corporate borrowing. That shift alters cash flows, equity valuations, and credit spreads. The fourth insight is housing's outsized role. In some economies, like the United States, shelter can exceed 30% of the inflation basket. Even gradual cooling in rents can tug headline inflation lower. Conversely, sticky rents can keep policy restrictive for longer. Earnings add a final wrinkle. Overall results have held up, but pricing power is getting more uneven. Sectors with strong brands, scarce capacity, or favorable cost bases are defending margins. Others face rising costs and tougher competition, which narrows market breadth. So what's the practical takeaway? Track upstream price gauges, fuel trends, and wage data for early reads on inflation momentum. Watch shelter indicators because they can swing the headline. Expect rate paths to shift with each data print, and stress test portfolios for both higher for longer rates and a gentle disinflation glide path. Quality balance sheets and sustainable pricing power tend to fare better when financing costs bite. Duration and credit sensitivity matter more when cuts are delayed. For ETFs and crypto, liquidity conditions and real yields can drive flows as much as narrative. Stay data aware, stay flexible, and let the inflation path guide your risk. Read the full article at finlitica.com. Quick reminder, this is general information, not financial advice. Your money, your decisions, so always do your own research.